My name is Jonathan Wilson. I am the CEO and co-founder of the Finsen Report company. I'm also a practicing attorney here in Atlanta, Georgia, at the Taylor English Duma law firm. The Finsen Report company was a company that we put together to provide an online filing system to help business owners and the attorneys that represent them prepare the BOI reports to be filed under the Corporate Transparency Act, and in particular to help law firms manage the large volume of filings that they are going to experience, keeping track of the PII for each individual in a secure and confidential way, and also keeping track of data changes at the reporting company level so that reporting companies are reminded when they need to file amendments. That's what our software does, but I won't be talking about the software on the system. This is not a demonstration of this filing system. It's not a sales call. I will refer briefly to some of the features and functions in our system as we go, but mostly we're here to go over the Corporate Transparency Act, and in particular, some advanced topics. I'm assuming that everybody here is already familiar with the Corporate Transparency Act and knows most of the basics. I won't be going over those. If you need a refresher on the basics, go to our website at finsenreport.com and find the next time we do the Foundations course. The Foundations course is the one that introduces you to the subject and covers all the basics a little bit more slowly. I'm going to zoom over pretty quickly a lot of the background and then dive into some of the edge cases and some of the more interesting twists and turns. If you've been on this webinar before, don't worry. It's never the same thing twice. Today is February the 13th, and this is not a recording. We are live. And just in the last 2 days, I've come up with two interesting wrinkles that I want to present on the webinar today for you to think about and talk about here. So what we're going to do is we're going to talk about the overview. We're going to go into some of the exemptions and some more details. Then we're going to talk about the process of figuring out beneficial owners when you have entities owning your reporting companies. And we're going to talk about some of the special cases involving data exclusions, such as for minor children and persons under guardianship. And we're also going to talk briefly about bankruptcy. Great to see everybody on the call here today. I usually zip through the list and I see a lot of familiar names. You know who you are, so good to see you again. Thanks for coming back. A lot of your firms have already gotten demonstrations of the software. Some of these firms are already using the software. So hopefully you're coming back to see how you can apply it in your firm. And I hope that is working out well for you. So let's dive right in here. There we go. Of course, folks know all about the Corporate Transparency Act. How it took effect January 1 of this year. It effectively will eliminate corporate anonymity. All the data that is filed with FinCEN under the Corporate Transparency Act is confidential. FinCEN is obligated by law to keep it secret, provided, however, that FinCEN can provide access to 5 different categories of entity, everything from banks to federal government agencies to law enforcement and then to state law enforcement. Those access requirements are subject to the FinCEN access rule that is still being finalized, and we're not going to cover that today. The Corporate Transparency Act, I think, has turned out to be much more complicated than people thought. And as a result, I think many business owners are going to need help from their trusted advisors. See, I told you that the slides change every day. That wasn't a typo the last time I used it. I'm going to have to correct that one. Firms are going to need help from their trusted advisors as they go through the process, and that's what we're here to talk about today. At its outset, everyone should know that if you don't know anything else about the Corporate Transparency Act, you should know that every reporting company that is not exempt needs to file a BOI report that discloses 5 pieces of PII, personally identifiable information, for each of those beneficial owners. Entities formed or that were registered on or after January 1 of this year must also identify and provide the same pieces of PII for their company applicant. We're going to talk later about what the company applicant is. Entities in this category must file their first report within 90 days of the date of formation. Entities that were formed or registered before the first day of this year do not ever need to identify the company applicant. So don't put a question in the Q&A box asking me how far back in time you have to go to find the company applicant. I get that question every time. The answer is you don't. You only need company applicants for entities formed this year and in the future. with respect to entities that were formed before January 1, 2024, you have until January 1, 2025 to file an initial report. So that's what we're all going to be working on for the rest of the year. There is no annual renewal. I saw recently that our friends at FinCEN had circulated a little video saying that it was a myth that there was an annual renewal. Not sure what myths they were trying to dispel there. Of course, there is no annual renewal. You only have to file once, except, however, that you will need to file within 30 calendar days after any of your beneficial owners should change, or if any of the data reported in respect of any of your beneficial owners should itself change. For example, a beneficial owner changes its address. So you got to keep track of the amendments. That's one of the chief functions of our software at FinCENReport.com. In our system, once a reporting company files its first report, if there is a change in beneficial ownership or a change in reporting data, we send up a flag inside the company's account and also in the law firm dashboard, if you're working with us, that alerts you to the fact that an amendment is required. If the company has bought the subscription from us, the company is able to file that amendment with the press of a button inside the system at no additional charge. That's really part of the secret sauce of our system. It's important to have a system in place to keep track of data changes because if the reporting company fails to report on time, it can be liable for a fine of up to $500 per day. And of course, a willful failure to file or a willful filing of false information can be a felony. So this is stuff that we take very seriously. By the way, if you want to see how you can use FinCENReport.com at your law firm, please go to the chat bar, click on the link to request a demo. We'll give you a copy of the recording of this presentation, and we'll also demonstrate for you how you can use the software at your law firm. So we start off with, what is a reporting company? A reporting company can be either a domestic reporting company or a foreign reporting company. A domestic reporting company is a corporation, LLC, or other entity formed in the United States by the filing of a document with a Secretary of State or similar office under the laws of a state or Indian tribe. Every time I say Secretary of State, just assume that I'm saying law of a similar office or Indian tribe, because that phrase is repeated all the time. If you have a question about what the similar office is, you can check out our website at FinCENReport.com. Go to the blog. I did a blog just last week on what kinds of offices might be similar to the Secretary of State. So because of this definition that hinges on the filing of a document, some entities are not reporting companies, such as a common law general partnership and most trusts at the state level. A foreign reporting company, of course, is any entity formed outside the United States that files to do business in the U.S. by filing a document with a Secretary of State. Either one of those two things are a reporting company, and all reporting companies are treated the same way, whether you're a domestic reporting company or a foreign reporting company. I talked about general partnerships, and also in most states, your trusts are not reporting companies because they are not formed by the filing of a document with the Secretary of State. One easy example to the contrary, though, is the Delaware Statutory Trust. DSTs are formed by the filing of a document with the Delaware Secretary of State, so Delaware Statutory Trust will be reporting companies. As I've called out before in this webinar, in some states, there is an emerging type of entity relating to decentralized autonomous organizations, or DAOs. I am not an expert in that particular area, but I did look at the law in Wyoming. In Wyoming, there is an amendment to their Limited Liability Company Act for DAO LLCs. So if your client is one of those, just think of it as another type of an LLC, which of course is a reporting company. Other states may be a little bit different. You'll need to check. As we all know, there are 23 different exemption types. They range from publicly traded companies to entities that are inactive. We're going to dig into some of the examples here in just a moment. Probably the most common exemption we're going to run across with our small and medium-sized business clients is the large operating company. To be exempt as a large operating company, you need to satisfy 3 requirements. First, you must have more than 20 full-time employees in the United States, with the definition full-time employee in the United States being used as defined in the regulations there. Those are the regulations from the Affordable Care Act, the Obamacare statute. And they do have some very specific ways of counting full-time employees. The entity must also have an operating presence at a physical office within the United States. This needs to be a place where it does business. It does not mean that all 20 employees have to work there, but it does need to be a physical location. If all 20 employees work from their home, that entity does not have a physical office, and it would fail the large operating company exemption. Finally, the third requirement, which is one of the more tricky ones, is that the entity must have $5 million on last year's tax return, and the $5 million has to be from U.S. source income, excluding income from outside the United States. So let's talk specifically about what that means. First, the trick about counting employees. One of my partners at the Taylor English law firm put together a blog post that you can find on the law firm site about this. There are all kinds of counting rules in the Affordable Care Act, because the purpose of that law was to prevent small employers from keeping their head counts below 20 and thereby avoiding the need to comply with Obamacare. So there are all these rules about how you have to aggregate your employees with affiliated and related companies in order to get up and over the 20 employee hurdle. The way the CTA exemption works, however, is that they use the counting rules from the Affordable Care Act minus all of the parts that have to do with the aggregation of affiliates. And FinCEN specifically talked about this in their September 22 release of the final rule. When you're counting full-time employees for your reporting companies under the CTA, you do not aggregate employees from other entities. You only count employees that are actually employed by the reporting company itself. So in the hypothetical I present, imagine you've got a parent co that's got more than 5 million in revenues, but it has no employees. It has all of its employees housed in employer co, which has no revenue, but does have more than 20 employees. Parent co also has an operating company, which generates all the revenue, so it's got more than 5 million, but it has no employees. All of its workers are basically leased to it via an intra-company employee leasing agreement from employer co to operating co. And so the question is, are any of these entities, or perhaps all of these entities, exempt under the large operating company exemption? To answer that question, we have to focus on prong 3 of the test, which is how do we count gross receipts? For the gross receipts test, first of all, realize we're looking at the income that was reported on last year's tax return. So an entity formed in 2024, even if it's the most glorious startup ever and has way more than $5 million in gross receipts, it will not be exempt under the large operating company exemption in 2024 because it did not have a tax return for last year. It might be exempt next year, won't be exempt this year. That kind of an entity would need to file this year. Next year, after it files its tax return, if it meets the exemption, it would file a goodbye amendment with FinCEN saying that it is now exempt and therefore will cease to file. And that would be the end of the filing experience for that company. But under the gross income test, companies are allowed to aggregate their income if they are part of an affiliated group for income tax purposes. So how do we count employees? As I mentioned before, FinCEN, when it rolled out this rule, expressly said that we are not going to be counting employees from affiliated groups. And it talked about the conflict between the Affordable Care Act regulations that aggregated employees across affiliates versus its approach. So for purposes of the CTA and counting heads for the exemption, we can only get to count the employees that are employed by each applicable reporting company. So for this example that I showed a couple slides earlier, there it is. Parent co is not exempt because it has no employees. Operating company is not exempt because it has no employees. But employer co would be exempt because it does have more than 20 employees and because its taxes are reported on an affiliated basis with its wholly owned parent co, it gets to count those revenues. So the somewhat non-intuitive outcome here is that employer co will be exempt, but parent co and operating co will not be exempt. Next time around, I'm going to have to put that graphic here at the end. That's the large operating company exemption. I see we have a couple of questions piling up. Most of these look to me like people who came to this presentation with their questions already in their back pocket. Here's one that relates to the large operating company exemption. If an employer has over 20 FTEs, but only 5 of them work at a physical headquarters, does it still qualify? The answer is yes. Remember, the operating presence requirement means that there has to be an office where somebody works, but all 20 of the employees do not need to work there. You could have an office with 1 employee in it, all the other 19 work from home. That still meets the requirement for the 20 employees, not a problem. Let's talk about tax-exempt entities. The left-hand side of the slide shows just about verbatim the requirements that are in the regulation itself. You are exempt under the CTA if you are tax exempt under 501c, determined without regard to section 508a, if you're the political organization defined in that section, or the trust of the kind described in that section. Most of our clients and most of the repetitions of this in our practice will fall under subsection A. One of the quirks that has come up is that there are some 501c entities, like churches, for example, that are presumed exempt. They are exempt from the time of formation, regardless of whether they ever get back an IRS determination letter. For those entities, they are exempt at the time of formation, and they should never need to file any BOI report. With respect to all of the other 501c entities that do require an IRS determination letter, which is what's referenced in section 508a, those entities do not become exempt until they get their IRS determination letter back. It seems to be the case that that often takes more than 90 days. So for a newly formed 501c entity that does require an IRS determination letter, that entity will get formed in 2024. Its first report will be due within 90 days, so it's probably going to beat out the IRS determination letter. So it's going to have to file that first report, saying that it's not exempt and identifying all of its beneficial owners. When the IRS determination letter comes back, at that point, the entity does become exempt. And just like the entity under the large operating company exemption, it would then amend its BOI report to say goodbye, that it's now exempt, it doesn't have to file anymore, and that would be the end of its filing experience. But for those of us who practice in the nonprofit space, forming new 501cs in 2024 and in the future, you're probably going to end up filing it first under the CTA and then amending the CTA to take advantage of the exemption after you get your IRS determination letter back. Okay, so let's talk about exempt entities and dissolution. I see that about 3 of you already brought your dissolution questions before we started, and that's okay. Everyone can see the citation there to the the inactive entity exemption. This was supposed to cover entities that were formed years ago that were just left on the shelf and never did anything. So there are 6 separate prongs of the inactive entity exemption. The reporting company must meet all 6 requirements, because they are in the conjunctive, in order to be exempt. So if you meet all 6, you're exempt. That's great. The next question becomes, well, I've got this thing that I created a little while ago, but it doesn't meet all 6 of the requirements. Can I just dissolve it and avoid the obligation to file? This is an area that has some controversy. Not everyone agrees. I think that the right answer should be yes, that an entity that is dissolved before 12/31/24 should not need to file, so long as the dissolution is one that is final as a matter of state law, so that the entity ceases to exist. Here's another example of information you can find on our blog. Go to finsenreport.com and click on the link to the blog. I did a lengthy analysis of the dissolution rules just a couple of days ago, I think, that digs into why I think this is the right answer. And in most states, as is the case here in Georgia, dissolution can actually have several different layers to it. In most states, there's a preliminary status where the entity files to say that it has begun liquidating. The entity is now supposed to cease conducting business, except as necessary to liquidate itself and distribute the proceeds. So it can sell off assets and so on, finalize lawsuits, enter into settlement agreements, all that good stuff, and only as a precursor to liquidating. Such an entity has not ceased to exist. Such an entity has definitely not finally dissolved and would still be in existence for purposes of the CTA, would still need to file. The second level of dissolution, as I described in that blog post, is one where the dissolution has become final and as a matter of state law, the entity ceases to exist. My opinion is that such an entity does not exist because state law says that it does not exist. If the entity does not exist, then it is not a reporting company, therefore it cannot have a duty to file. In addition, because companies don't file, senior officers of reporting companies file, right, under section 380G. Since an entity that does not exist cannot have an officer, then there is no human being who can stand in the shoes of the officer in order to file for that dissolved reporting company. So in my view, if I were the judge, I would say that a finally dissolved entity, anytime before the end of this year, does not need to file. However, there is some conflicting views on this. I actually went out and did, and I cite some of these in the blog post, tried to find all the law firm memos I could on this particular point. And I found several that agreed with me that a fully dissolved entity ought not need to file. But I am aware of some other very well-regarded attorneys who have studied this topic that reach a different conclusion. Their conclusion is based on some of the dicta in the September 22 release that FinCEN did of its final rule, where FinCEN was saying, well, there could be such a thing, and even if it were dissolved, then it might file, and it gets a little bit confusing. My personal view is that that was just some inartful drafting on the part of someone, and it's not really part of the law. I'm also not really persuaded by that dicta that an entity that does not exist as a matter of state law, and as a matter of state law has no senior officers, can nevertheless somehow have a duty for its officers that don't exist to file a report about the beneficial ownership of a company that doesn't exist. To me, that's just Alice in Wonderland thinking. But to be totally prudent, if you wanted to be as conservative as you could possibly be, if you were in the process of dissolving an entity during 2024, you might consider filing before you dissolve the entity, simply to say that there was an entity that was owned like this, and now it is dissolving, and therefore, goodbye, FinCEN, we're not going to file again. Some attorneys might think that that's overkill. You're going to have to exercise your own judgment, but that's the latest on the dissolution question. I found another one. This is just from this morning. This came from a real live client issue. So everybody knows that a securities reporting issuer is exempt. You are a securities reporting issuer if you file your registration statement so that you have issued securities under Section 12, or if you have reached the size that is required to file periodic reports under Section 15D of the 34 Act. That's the easy one. I think folks should know also that the entities that often are traded on the OTC bulletin board, the pink sheets, often those entities have their shares being retraded in the marketplace, and they think of themselves as being publicly traded. They sometimes even use the phrase publicly traded, but most of those entities are not, in fact, securities issuers because their securities are not registered and they are not filing their periodic reports under Section 15D. But the question came up this morning, what about an issuer of ADRs, American Depository Receipts? Is an entity, which of course would be a foreign company, right? So it would be a foreign entity doing business in the US. Shares in the foreign entity are registered for sale on some foreign exchange outside the US, but those non-US shares are available for purchase and trading as ADRs as the result of a filing of a Form F with the SEC. And the answer is, it depends, as it almost always does. Apparently, and I'm just repeating what I've read here, I'm not an expert in this area of securities law, there are two different types of ADRs. There are sponsored and unsponsored. And within the category of the sponsored ADRs, there are several different levels. The unsponsored ADRs and what's called a sponsored level 1 ADR are ADRs that have been sponsored by a bank, not the issuer. And the bank is basically holding the foreign securities and in essence trading receipts. That's the ADRs, the receipt with the US securities purchasers. For those entities, the issuer has not registered anything, and the issuer is not filing periodic reports. So neither of the two prongs of the securities issuer exemption applies. So a foreign company that has that type of ADR is not a securities issuer, is not exempt. However, levels 2 and 3 of the sponsored ADRs do involve a foreign issuer that is issuing periodic reports. Those are securities for purposes of Section 12, and those are very likely going to be exempt. This can be a little bit tricky, so you should be consulting with your securities counsel if you think you have a client that falls into one of those categories before you finally rely on the exemption. Okay, so that gets us through all the really cool new exemption stuff. At this point, everyone should know that a beneficial owner is an individual that directly or indirectly owns 25% or more of the ownership interest of the company, and is also an individual who exercises substantial control over the reporting company, regardless of whether they own anything at all. Everyone should know that the definition of beneficial owner in the CTA is different from the definition of beneficial owner in the KYC regulations that banks administer today. At some point in the future, those two regimes are supposed to be harmonized, but that has not happened yet, and we don't know when FinCEN will get around to it. In addition, and again, once again, company applicant is only relevant for entities formed on or after January 1, 2024. Pre-2024 entities do not ever need to identify their company applicant. Don't ask me how far you have to go back. So who is the company applicant? Before January 12, all the law firms were doing backbends, trying to figure out ways that they could ensure that they were never going to be a company applicant. I even saw some law firms that were trying to modify their engagement letters and so that the client would agree that the client would be the company applicant. None of those backbends are going to work. FinCEN updated its FAQs on January the 12th. Go look at FAQ E5 on the FinCEN FAQ webpage. It is now very clear that the company applicant for one of these reporting companies is the individual who directly files the document that creates the entity. So if you're at a law firm and your paralegal is the one who directly files the document with the Secretary of State, that individual paralegal, not your firm as an entity, but the individual, is the first company applicant. If that same paralegal gives the articles to an employee at a corporate service provider, and that employee files the document, then that employee is the company applicant, not the paralegal. If there is more than one person involved in this process of filing the document, however, there must be a second company applicant, and FinCEN says that that second applicant must be the individual who is primarily responsible for directing or controlling the filing. Now, when you look at the FAQ E5 from FinCEN on their webpage, they've given you a couple of scenarios. One where the client calls the lawyer gives the document to the paralegal, and so on and so forth. In the context of the client calling the lawyer and then the lawyer handing it off, the lawyer at the law firm is the person who is primarily responsible for directing or controlling the filing. FinCEN is not going to buy that the client told the lawyer to tell the paralegal to tell the corporate service provider how to file the document. They're going to pin that on the lawyer. If somehow a business owner directly calls or contacts a corporate service provider and tells that corporate service provider to file, then the employee of the corporate service provider will be the first company applicant because that person directly filed the document, and then the business owner will be the second company applicant because that person chose the corporate service provider and told them to file. But as a general rule, if you're a law firm and there is both attorneys and paralegals and sometimes service providers involved, you're going to have to develop a system inside your law firm of keeping track of who was the company applicant. If you're working with FinCENReport.com, we track that data for you. That's one of the data points that you would enter into your dashboard, and that's one of the ways that we help our law firm partners. So once you have a reporting company that is not exempt, you first have to figure out who is an owner by virtue of ownership percentage. And you need to calculate ownership percentages at the present time with any options or similar interests of the individual being treated as exercised. So if an individual owns some common stock and also owns a convertible note that's convertible into stock, you treat the convertible note as if it has been converted to get the largest possible percentage for the individual. Then for the reporting company, you either apply the partnership capital rule or the corporate capital rule to determine what the percentage is. Each of these are fairly complicated. I'm not going to read them all now. Perhaps the most head-scratching one of these is the partnership capital rule, because the text of the regulation says that we need to calculate what the individual owns in terms of its capital and profits interests as a percentage of the total outstanding capital and profits interests of the entity. In other words, if you took everything and then you took the individual share of everything, what would that share be if it were a percentage? Some of my friends who are primarily tax lawyers are finding it difficult to wrap their heads around this. I spent 20 minutes on the phone with one of my partners not long ago because he said, well, look, a profits interest is something that you give a service provider. It's like a carried interest in the entity. The capital interest represents how much cash did you contribute with additions for income and adjustments for losses. You would never take your profits interest and add them on top of your capital interest. And I'm sure that's right from a tax point of view. I'm not a tax lawyer, but all I can do is describe what it is that the FinCEN regulation says. And the FinCEN regulation very clearly says that we're supposed to combine the capital and the profits interest and then figure out what percentage an individual has of the whole. If you look, for example, on the FinCEN Small Entity Compliance Guide, they only give us one example, and it's a very simplistic example, but FinCEN itself in that publication very clearly shows A divided by B, where A is the combination of the capital and profits interests for the individual, and B is the combination of the same for everybody. So in my view, you have to take a liquidation value of the company, determine how it would be allocated among all the owners, and then figure out whose percentage would be greater than 25. The corporate capital rule is a little bit different. You take the greater of the share of the vote or the greater of the total combined value of the ownership interest, which is kind of like the same thing as the partnership capital rule, and then see who has more than 25% of either one of those two categories. The fail-safe rule. If your calculations of percentages do not allow you to reach a conclusion with reasonable certainty, then you have to apply the fail-safe rule, in which an individual is a beneficial owner if they have 25% or more of any class or type of security. In my view, this comes into play in a lot of our LLC operative agreements where we have multiple levels of waterfall. I'm going to skip over the explanation now. We have some examples later on in the slides, but I think that's where the fail-safe rule comes into place. And we're all going to be cracking open our operating agreements this year to figure out how we're going to apply the fail-safe rule for a lot of our clients. Some of the special rules you need to know about attributing ownership to an individual. If you have a reporting company that is owned by another reporting company that is not exempt, you do not report the name of the non-exempt reporting company. Instead, you look up the chain of ownership to see whether there are any individuals who indirectly own 25% or more of your reporting company. However, if there is a reporting company that is exempt, that by itself owns 25% or more, you don't have to look up the chain from it. You actually just list the full legal name of the exempt reporting company. That's called out in the regulations. If you have another entity that is an owner of your reporting company and it is not a reporting company, for example, it might be a trust or it might be some other arrangement of joint ownership, you have to look at the individuals. If it is a trust, you apply the trust rule of section 380 D2C. If it's anything else, you have to follow the guidance in section D22. And that brings me to married individuals and community property states. This has thrown a bunch of folks for a loop. If you have an individual who is a beneficial owner by virtue of ownership percentage, and that individual resides in a community property state and is married, you have to stop and take a deep breath. You probably are going to need to get co-counsel from the local state, and you need to analyze whether the ownership interest in the reporting company is community property or not, because if it is, then the spouse must also be identified as a beneficial owner. It's not an ironclad rule, however, because in some of the community property states, there are situations in which an ownership interest in a reporting company might not be community property. And whether it is or not can depend on when the interest was acquired, how the interest was acquired, and whether there is an agreement between the spouses, such as a prenuptial agreement, that might break the undivided joint interest they would otherwise have in community property. So all you can do on your checklist as you're going through and identifying beneficial owners is stop and ask for the state of residence of the beneficial owner at the individual level, then inquire if they are married, and if they show up in one of the 9 community property states, stop, take a breath, and you're going to have to dig another level deeper. After you have compiled the list of all of the beneficial owners by virtue of ownership percentage, you then have to go through your substantial control test. I'm not going to read all this to you. You'll know where to find it in the regulation. Just be aware that your checklist for including beneficial owners needs to include all of the individuals who are covered by the substantial control test, even if they don't own anything and are not beneficial owners by virtue of ownership percentage. And that leads up to the decision tree that you've seen on this webinar before. Is it a reporting company? Is it exempt? If it is exempt and it's a foreign pooled investment vehicle, there are special rules. Crack open the regs to see what they are. If it is not exempt, then go through your analysis. Who are beneficial owners by virtue of ownership? Who are beneficial owners by virtue of substantial control? List them all. Then go and figure out whether you need to disclose your company applicant, and if so, include that data. I've shown this before. This is basically a graphic depiction of the decision tree I just showed you. This is what we incorporate at FinCENReport.com into our calculation wizard. If your law firm works with us, you have the wizard there in your law firm dashboard, so that you're able to run through this logic the same way every time with every one of your clients to make sure that you don't inadvertently miss something. We got a new nugget here today. The data required for each beneficial ownership report is summarized on this slide. It's all the stuff that we just went over. The nugget I found this week is that there are some reporting companies that do not have EINs. In particular, an LLC that is 100% owned by another LLC that is taxed as a partnership. The subsidiary entity, which is the reporting company, would be a disregarded entity for tax purposes. And often we advise clients not to get an EIN for those entities because there often is no need to. You would have the bank accounts in the name of the parent company. You might even run payroll in the name of the parent company. The subsidiary entity, disregarded for tax purposes, would have no need for an EIN. Here's the problem. FinCEN's regulations assume that every reporting company has an EIN. So what do you do and how do you file if you're a reporting company that doesn't have an EIN? To be honest, we still don't really know the answer. I think the answer should be that the disregarded entity should report the EIN of its parent company. Again, we're assuming 100% ownership. There is some dicta in FinCEN's directions on its website that suggests that that's the right answer. However, it's not entirely free from doubt. I actually tried to submit this question to FinCEN's Help Center, and the robot that's giving out answers gave me an answer that was so far off that tells me they didn't really understand the question. I'm following up, and if I get a better answer in the future, I'm going to go ahead and put that in the slides for the next time around. But just realize that that's an issue. If you need to file in 90 days, maybe go get the EIN. Maybe go ahead and report the name of the parent company, and go ahead and submit your own question. Maybe FinCEN's Help Center will eventually catch up with us, but that's a bit of a squirrely issue I've come across. So the process that you really ought to be following for your reporting company clients is to collect all the information, the cap table, the list of all the officers, the shareholders agreement, the operating agreement, anything else that might bear on control, and then go through all of it following the logic that we suggested in the decision tree, and thereby come up with a comprehensive list of your beneficial owners. Then the trick comes to be how are you going to collect all the PII from those individuals? Obviously, that's where FinCENReport.com comes in. What our system allows you to do is keep each individual's PII separate and confidential. The way our system works, each individual only gets to see their own data. In a reporting company that might have 10 different beneficial owners, only the lawyers and the senior officer at the reporting company get to see who the beneficial owners are. They don't get to see any of the beneficial owners' PII. That all remains confidential. If you want, you can even go to finsenreport.com right now, click on the Get Started button and create your own account. It's entirely free to create the personal account. We're just going to collect your email address. Then you'll be able to interact with the software, see how it works. Again, it's all completely free. Get a sense of whether this might work for you. If you want to get a demo of how we could work with your law firm, go to the Q&A tab, click on the link to request a demo. We'll be able to show you how this dashboard can be implemented into your practice, how you can use it to organize all of your client reporting companies so that for each one you have a separate file that collects all the data for the company and allows you to interact with all of the different beneficial owners, allowing them to keep their data confidential while at the same time making it available to be covered in the report. That dashboard is available for your law firm. Each reporting company pays a $199 per year subscription fee. It doesn't begin until they file for the first time. So all of the preliminary work, all the connections work gets done before we've asked anybody for a credit card. When the reporting company goes to file for the first time, that's when we ask for the credit card. And that fee covers an entire year of service. So to the extent that there are amendments throughout the year, those amendments are all included for free, no additional charge. It's an all-you-can-eat sort of pricing and covers all the amendments. So let's dig into some of the examples. This is the good stuff. In this first example, Larry, Bill, and Sally form a corporation. They each get 1,000 shares of common stock. Larry's the CEO, Bill is the CFO, Sally's the head of marketing, and all three are members of the board. Who are the beneficial owners? Well, this is an easy one. First, all three of them are beneficial owners by virtue of their ownership. They each have 1/3 of the common stock, which is greater than 25%. That outcome is reasonably certain because it doesn't matter whether the corporation is worth $1 or $1 billion, it would still be 33%. So all three are beneficial owners. Looking at substantial control, we only have 2 senior officers here, Larry and Bill. Sally is not. So Larry and Bill would also be beneficial owners by virtue of the senior officer rule. Finally, however, because each of the 3 is on the board of directors, I would make them all be beneficial owners on that basis as well. One thing to watch out for, on its website, FinCEN has an FAQ that says something like, are all members of a corporation's board of directors automatically beneficial owners? And their answer is no. You're only a beneficial owner if you have substantial control. My problem with that answer is that it might be true, but it's misleading. It's very difficult to imagine how an individual can be on a corporate board and not have substantial influence over major decisions. A corporate board member is present for the vote. They would have the ability to be in attendance at the meeting, talk to the other board members, have the benefit of all the other documents and information that would be a part of the decision. They would have a vote. They would have substantial influence. Their influence would be real. So in my book, the prudent approach is to include all of your corporate board members as substantial control persons who are beneficial owners. Example number 2, same scenario as before, but this time Sally only gets 100 shares. Who are the beneficial owners now? Well, only Larry and Bill are beneficial owners on the basis of ownership percentage. Only Larry and Bill are beneficial owners by virtue of their senior officer role, but under my rule of treating all of your board members as beneficial owners, I would still include Sally once again because she's on the board of directors. A tweak on the facts: Larry, Bill, and Sally form the corporation. Each get 1,000 shares of common stock. Along comes Blackbeard. Blackbeard invests $1 million and gets 1,000 shares of preferred stock, convertible at a ratio of 1-to-1 into common. Blackbeard also has the power to appoint 1 member to the board of directors. Who are the beneficial owners now? Well, we're going to treat Blackbeard's preferred stock as if it's converted, and after it's converted, each of Larry, Bill, and Sally has more than 25%, and therefore each is a beneficial owner. That's easy, all 4 of them. Next, we look at substantial control. Nothing has changed with respect to Larry, Bill, and Sally. All 3 are substantial control persons in my book. Now, Blackbeard has the power to appoint 1 person. If he appoints himself to the board, he, in my book, would be a beneficial owner by virtue of substantial control. If Blackbeard appoints someone else to the board, I would also include that person by virtue of their board seat as being a beneficial owner. Okay, so now it begins to get really fun. Let's look at a fairly typical real estate deal where we have 3 different LLCs investing into one reporting company. In this hypothetical, Property Co. contributes real property with a value of $5 million. Investor Co. contributes cash of $5 million. Developer Co. doesn't contribute any cash, but developer is the one who puts the deal together and hires the general contractor and all that. In our operating company waterfall, at the first level, Property Co. and Investor Co. are going to split cash 50-50 until each has returned all of their contributed capital plus a return. In the second level of the waterfall, developer is going to get 100% until developer gets $1 million. Thereafter, all of the remaining distributions are going to be split 25 to Property Co., 25 to Developer Co., 50% to Investor Co. Ignoring substantial control and focusing only on ownership percentage, who is a beneficial owner now? Well, this is the example that I mentioned earlier about reasonable certainty. If you don't know how many dollars are there to be distributed, you cannot calculate what the percentage interest is of either of these 3 entities under the partnership capital rule, because you don't know what the total profits interest is. So in my book, this is one that has to be covered by the fail-safe rule. In other words, we're going to look at each level of the waterfall to see who it is that has 25% or more of any class or type of security. That's the fail-safe rule. Well, look at our waterfall. What are the different classes of securities under this waterfall? Well, at the first level, Property Co. and Investor Co. have 50%. At the second level, Developer Co. has 100%. And at the third level, it's 25, 25, 50 between property, investor, and developer. Sorry, property, developer, and investor, the other way around. So all 3 of these entities would be beneficial owners if they were exempt reporting companies. If they were all exempt reporting companies, we would just list their 3 names and we would be done as far as this part goes. But in our hypothetical, they are not exempt reporting companies. They are not exempt, so we need to look up the chain of ownership. So modify the facts a little. Same facts as the previous example, except in this case, Property Co. is owned by 5 individuals, each of whom has 20% of Property Co. each. Now remember, Property Co. has 50% at the first level and 25% at the last level. So if these 5 individuals have 20% of Property Co.'s 50% interest, each of those 5 individuals has only 10%. On the basis of ownership percentage, then, none of these 5 individuals is a beneficial owner, and none would need to be reported at that level. Okay? Again, we're ignoring substantial control. We're going to get to that later. Once we got to substantial control, we would need to look at the operating agreement of reporting company and property company to see when there would be a vote, who the senior officers were, who was on the board of managers. All of those questions would inform our substantial control analysis. Next example. Same facts as the last one, except that in this case, Investor Corp is exempt. Let's imagine it's a large operating company. In that case, it's real easy. Investor Corp is a beneficial owner. It's exempt. So all we have to do is report the name of Investor Corp. That's it. Let's tweak the facts just a little bit and apply the minor child rule. In this case, Property Co., remember, which has at one level of the waterfall 50%, it is owned in equal percentages by Daddy Warbucks and his child Fauntleroy Warbucks. In this case, Fauntleroy is 14 years of age. And let's assume, for the sake of argument, that he is a minor in this case. So what do? Well, the regulation cited there says we don't report the name and information of a minor. Instead, we're going to have to report the name and information of a parent or guardian on the part of Fauntleroy. Bonus question, would the outcome change if Fauntleroy was at the age of majority in the jurisdiction where he resides? No. Under the minor child rules, we have to apply the law of the jurisdiction where the reporting company is formed. In most of the 50 states, the age of majority is 18, but there are a few unusual examples. Mississippi, Missouri, and a few others are those. So you're going to need to examine those if you come across the minor child situation. Another rule of exclusion involves custodians. Same facts as number 4, except in this case, Developer Co. is owned in equal measures by Walter White and his adult son, Willie White. And we're going to assume that Willie White is an individual with special needs, and all of his financial and legal affairs are handled by a legal guardian. So he does not make his own legal decisions. He cannot make a contract. Because both Walter White and Willie White are beneficial owners of the reporting company, they would each ordinarily be beneficial owners, but Walter White's affairs are handled by a guardian. Well, Section 380D32 says that we don't report information for a nominee, intermediary, custodian, or agent. So in that case, we would report the personal information of Willie White, even though he's the special needs individual whose financial affairs are handled by a legal guardian. We still give his name, we still give his date of birth and home address. A twist on the facts. Let's imagine that Willie White is still an individual with special needs, all of whose affairs are managed by a legal guardian, but he in this case is a minor. Well, because he's a minor, the rule of minority applies. We would not report Willie White's information. We would instead provide the information of the parent or guardian on behalf of Willie White. Bonus question. When Willie White reaches the age of majority, what happens? Well, the answer, as I cite to the regulation there, is that when Willie White reaches the age of majority, that starts a 30-day clock ticking from his birth date, by which time this reporting company is going to have to amend its report to now disclose, to now take away Willie White's, or rather to disclose Willie White's information, because he has now reached the age of majority, even though his legal affairs are handled by a legal guardian. Bankruptcy. This is another one that is going to create more problems as we go along. Imagine that the exact same reporting company has a bad go of it, and it files for bankruptcy. When it files for bankruptcy, the court appoints Sherman Peabody as the trustee. What does the reporting company do? Well, definitely the reporting company is going to need to amend its BOI report. The individuals who were formerly beneficial owners by virtue of ownership are still beneficial owners. The filing of the bankruptcy case has not dispossessed them of their ownership, so they would remain in place. Individuals who were beneficial owners solely by reason of substantial control now need to be removed. By virtue of the stay in bankruptcy, they no longer have control. They are no longer making decisions. They are no longer in power. So they would all be removed as beneficial owners in that amendment. The tough part is, what do we do about Sherman Peabody? I think the prudent approach would be to identify Sherman Peabody, who is a bankruptcy trustee, as an additional beneficial owner by virtue of substantial control, because that person is the most senior operator in control of the company, subject, of course, to orders of the bankruptcy court, but a person who has very likely has substantial control by virtue of being a bankruptcy trustee. Now, this conclusion is also not entirely free from doubt. The reporting rule does not say anything at all about bankruptcy. There really was not any discussion of this in FinCEN's 2022 release, but I think our best guess is that we include the bankruptcy trustee. That is the end of the presentation. I'm going to go through and see if I can answer any questions that have come up here. I'm going to skip over ones that I know that I've already answered. And you mentioned that amendments are needed within 30 days. Doesn't FinCEN reports need to be amended for any business change, such as a change in its business address? Yes, if a reporting company changed its address, changed any information about the company that was covered by the first BOI report, that amendment does need to be filed within 30 calendar days of the change. Yes. Okay, question about trustees of a family trust. I'll summarize the trust rule for you here, but if you have a practice that covers trusts and estates, you probably want to sign up for one of our trusts and estates webinars. Go to finsenreport.com to find the schedule and sign up for the next one, because we go really deep into the trusts and estates issues. If a trust owns 25% or more of the reporting company, we don't put down the name of the trust as a beneficial owner. Instead, we apply the trust rule, which is section 380D of the regulation. And that is that we identify the trustee if the trustee has the power to dispose of substantially all the assets of the trust. We identify the beneficiary if an individual is a sole beneficiary, or if the individual has the power to compel a distribution of the assets of the trust. And we will disclose the grantor or settlor of the trust if that grantor or settlor has the power to revoke the trust. So depending on the facts, it could be as many as 2 out of those 3 different categories, and you have to look at the trust document to get the right answer. So that's the trust rule. Again, come back for the trust and estates seminar if you want to dig more deeply into that one. We're getting down to the end of our hour here. I want to focus on a few of these questions here. Here's a great one. What is the role of spouses in substantial control? The CTA definition is broad and vague. Okay. If a business owner regularly consults a spouse by virtue of being a spouse and is an informal consultation, does that spouse have substantial control? I think not. Now, we're talking about substantial control for spouses. We're not talking about community property. That's a whole nother kettle of fish. But I don't see anything in the definition of substantial control that says that we ought to include a spouse. Substantial control has the 4 different levels to it, and the last of which says we should include anyone who has any other form of substantial control. It's hard to imagine a spouse that would have that level of influence. I can't say it would never happen, but I think in general, FinCEN is not looking for us to disclose the names of all the spouses of all the individuals who have substantial control, even if there's such a relationship that a spouse is, especially impactful on the individual. A question here about a shelf entity that doesn't have an EIN. There is the problem about the EINs that we're looking into, but just because the entity was formed and doesn't have any owners yet, it still is going to have beneficial owners. If the entity was formed and it is in existence today, it's going to have to file a report. And whoever it was that ordered it to be formed is in all likelihood going to be one of the beneficial owners. That entity will need to file. One of my colleagues here noticed that I skipped over one of the details in my hypothetical that showed parent co, employer co, and operating co. He is noting that I assumed that employer co had a physical place of business in the United States. You're right, I did assume that it would need to have a physical place of business in order to satisfy all 3 elements of the large operating company exemption. Good one. Here's a great question. Can franchisors be considered to have substantial control over a company given the nature of franchise agreements? For example, franchise agreements typically need the consent of a franchisor to sell a franchisee unit to another. Great question. I'm not sure that I have a great answer for you right off the cuff. Substantial control is definitely something that is not limited to ownership, right? You don't have to own anything at all to have substantial control. Could a franchisor have substantial control? It's quite possible. There's definitely no discussion of this in the FinCEN regulations. There's definitely no discussion of it in the 2022 release. I know there's no discussion of it in FinCEN's FAQs. So that is an open question. That's something we'll dig into and maybe talk about on another one of these webinars. So I think that's all the questions I've got there. Someone notices that there are some states that allow individuals to opt into community property arrangements. That is true. I believe Alaska is one of those states, but I don't know if there are others or not. Community property is definitely a ticklish area. So that's the end of what I have for today. Thank you so much. Like I said, if you'd like to get a copy of this recording, please click on the button to schedule the webinar. We'll be happy to give you a copy of the slides and the recording then. I hope this has been helpful. Check in with us at another presentation, and I'll follow up as these new hypotheticals keep coming out and we keep learning more. Thanks you so much. Bye-bye.